Hello, everyone. Welcome to the BDO Financial Reporting Update webinar. My name is Elisa Noble, and I'm joined today by Grant Hasty. We are both from BDO's Technical Financial Reporting team. BDO is open for business as usual, but as you might expect, we're all working from home. So please do bear with us if any technical issues arise. There will be a recording of the webinar available through our website, so you can always listen to that at a later date if you do come across any problems today. Now, sorry, I just had some messages about some people might not be able to hear. I hope that works for you. Sometimes it helps to refresh the browser, for example. So today's webinar may take a little longer than usual because we have added in some additional content about the recent developments relating to the coronavirus outbreak. That will be the first topic we'll be covering today. If you do have any questions, you can, as usual, use the question and answer function. We'll see if we've got time to answer them. If not, we'll get back to you later, or you can always get in touch with your usual BDO contacts or the contact us functions through our website. So on the agenda today, as I mentioned, we'll be starting with the coronavirus. After that, a bit of an IFRS update, looking at some changes coming up on primary statements, as well as some additional comments about lease terms from the Interpretations Committee. For UK GAAP, we'll be looking at some recent amendments and the Triennial Review Amendments. And we'll finish off with some narrative reporting relating to streamlined energy and carbon reporting requirements, Section 172 statements, and some final news items from the FRC and updates on Brexit. So let's start. As individuals and businesses, we have all been affected by the coronavirus pandemic or COVID-19. We'll probably use both of these terms for the purposes of this update. You'll all be well aware that the government, the Financial Reporting Council, and other regulatory bodies have issued a number of statements with guidance and certain reliefs in order to support businesses in the current circumstances. Many of these have financial reporting implications. So we've prepared for you a summary of some of the key points and considerations, and we will share BDO's guidance. This reflects information and our understanding as at today's date, the 2nd of April, though please do note that any update on these matters can quickly become out of date. The coronavirus has thrown financial reporting into turmoil, with market, regulatory, and legal expectations and requirements changing at speed. On 26th of March 2020, the FCA, the FRC, and the PRA issued an important joint regulator statement in which they indicated that in these extraordinary circumstances, previous market practices relating to the timing and content of financial information and the audit work that is done must change. Necessary changes are likely to include more modified audit opinions and material uncertainties related to going concern, changes to the timetables for publication of financial information, and the need for investors, lenders, and other users of financial statements to take into account these circumstances and accept the resulting delays in the provision of financial information, the need for auditors to undertake additional work, and the increased use of modified audit opinions. So it's clear the regulators expect companies and their advisors to carefully consider the conditions that we now find ourselves in, and to take the time necessary to ensure that corporate reporting, when it is published, is of the highest quality and greatest relevance possible. In order to allow this to take place, a number of legal and regulatory exemptions have been put in place, which we will summarize in the next slide. All companies can now apply to Companies House for a 3-month filing extension. AIM-listed companies can apply to AIM regulation through their nomads for temporary relaxations to certain AIM rule requirements, including a 3-month annual report filing extension, temporary share suspensions to allow for AIM notification obligations to be met, and a delay in cancellation of suspended shares. For companies listed on the main market of the London Stock Exchange, a series of temporary measures have also been announced. These include a moratorium on the publication of preliminary announcements, This is coming to an end on the 5th of April 2020. An extended 6-month deadline for the publication of accounts. That's instead of the usual 4 months. Relaxations to the mandatory audit tender rules. You'd have to apply to the FRC for approval for that for up to 2 years. And a relaxation of audit partner rotation rules, which would need audit committee approval, but not the approval of the FRC. That can be extended from 5 to 7 years. Companies' annual reports will be significantly affected by the coronavirus. A lot of guidance has been released about the corporate reporting effects. The FRC has issued guidance several times, and most recently last week on the 26th of March. At that time, they highlighted some of the more important matters that companies must consider when preparing their annual reports for December 2019 year-ends and onwards. We also have 2 international financial reporting bulletins published by BDO Global on the financial reporting effects of the coronavirus separately for 31st December 2019 year-ends and on 2020 year-ends. We'll go through some of the key points in the next slide. Do note that the FRC's guidance addresses a number of other matters, including corporate governance considerations around internal controls and management information. So we do really recommend that you read the FRC guidance in full for yourself. In terms of impairment, a lot of people have been commenting on that as well. The ISB, ESMA, various prudential regulators, including the UK PRA, have commented on the application of the IFRS 9 expected credit loss model in the context of coronavirus. BDO Global is currently in the process of drafting some guidance on impairment reviews in the context of the coronavirus, and this guidance will cover the application of both IFRS 9 and IAS 36. So please look out for that coming up on our website. Looking at the implications in a little more detail, for December year-end, as at the 31st of December, the World Health Organization had not yet declared the coronavirus to be a global health emergency. That is something that happened on the 31st of January this year. So that means that it should be treated as a non-adjusting event for the purposes of impairments and other estimates at the balance sheet date, unless perhaps in a situation where the business had significant operations in the first affected regions of China. This is because these estimates should be based on reasonable and supportable information that was available at the balance sheet date. That doesn't mean, though, that there's nothing to consider in the accounts. So very importantly, the narrative reporting should always be as up-to-date as possible at the date the accounts are approved. So we'd expect the effects of the coronavirus to be clearly addressed in the strategic report. Many companies are including it as a principal risk, for example, due to the effects on supply chains, changing customer demands, and the effects on the workforce. Post-balance sheet event disclosure will need to be provided if there are any significant effects on the business. This could include, for example, expected future impairments, breaches of covenants, supply chain disruption, workforce disruption, trading disruption, etc. These disclosures should be as specific and quantified where possible, with any uncertainties highlighted. For going concern, entities do need to consider events that have occurred both before and after the balance sheet date when considering whether or not there's a material uncertainty over the ability of the company to continue as a going concern. Many companies are concluding that they do have such a material uncertainty as a result of these circumstances. The forecasts, expected compliance with covenants, and the availability of financing all need to factor in the estimated effects of the outbreak. We'll come back to going concern in a little while. In the financial statements, though the numbers in the primary statements will be largely unaffected, the effects of the coronavirus will need to be considered when drafting some of the more forward-looking disclosures. So, for example, your disclosures about the significant accounting estimates and judgments, these should be very, very clear in terms of the basis that has been used so that readers can understand the changes post-year end. So for example, if sensitivity analysis, that would be really helpful and important to explain the basis on which it has been put together. Similarly, for financial instruments, risk disclosures about credit market and liquidity risk. Okay, so what happens when we get to 2020 year ends? In this case, for the narrative reporting, forward-looking disclosures and going concern, all of this is the same as for December year ends. It should reflect the latest information. Additionally, though, impairment tests and other accounting estimates will also need to start to consider the effects of the virus from 31st of January onwards. So for anyone with a January, February, or March year end, you'll need to consider what the effect of the virus was at the balance sheet date. Though do remember that everything in the balance sheet should be classified and measured using information that was reasonable and supportable at the balance sheet date. And so, for example, for a January year end, we need to be quite careful not to apply hindsight in terms of matters that might have happened at the end of March. So what effects will we see in the balance sheet? You'll need to very carefully work through impairment tests. There will certainly be indicators of impairment. IFRS reporters will need to consider expected credit losses. You may be renegotiating your debts or have covenant breaches, all of which have accounting implications. You may have onerous contracts to record. Your deferred tax assets might no longer be recoverable. Lease terms, in terms of the length of the lease term under IFRS 16 could change. You might be reversing revenue under IFRS 15 if your variable consideration estimates change. So there's a lot to think about, and this is going to be quite a task for many companies. In the guidance the FRC provided last week, they set out their high-level expectations in respect of financial statements, covering the areas in the boxes on the screen. We've already mentioned most of these areas, but as a general message, the FRC expects all disclosures about the effects of the coronavirus to be entity-specific and for the key assumptions and judgments to be made very clear and for the sensitivity of estimates to be clearly disclosed. So those are some of the overall messages that would apply to different parts of the accounting. On dividends and capital maintenance, the FRC reminded companies that where they have proposed but not yet made a dividend, so perhaps a dividend that's been declared but not yet paid, directors need to consider the position of the company when the dividend was proposed, but also when it is made. And if the company is no longer able to pay that dividend, then the directors should halt any such dividend payments and communicate appropriately to the market. Also from the FRC, in this case, the FRC's Financial Reporting Lab, what they've done is put together a really useful infographic, which we suggest you take a closer look at. So I'm not sure if you can see the details on the screen there. But what they've done is come up with 5 current questions which investors are seeking information on in reviewing accounts of companies to understand the effects of the coronavirus. So take a look at those questions, and there's some more detailed bullet points below them. You can access that through the FRC's website. The key message is cash is really, really important, and this is all about disclosing information about a company's liquidity, viability, and solvency. That leads us on to going concern, because clearly many of those disclosures would be relevant to a going concern assessment. Now, assessing going concern at the moment is really difficult. Why is that? Because existing projections are likely to be unrealistic, and it's very difficult or impossible for many companies to actually adjust those forecasts, because it's almost impossible to come up with supportable assumptions about the effect that the coronavirus outbreak will have on your forecast cash flows. None of us know how long the situation and the problems are going to last. So a different approach to going concern might be necessary. Your auditors would expect the company to lead on this, to perform the going concern assessment, you may need to start from scratch. It's often helpful or it makes sense to not start with those existing forecasts, but to start again and consider what is it that could break the company. That means if things go wrong, at what point does the entity run into serious difficulties, and what can and what is being done by the company to mitigate that. So this would then give you a good basis to arrive at your conclusions about material uncertainties and for the disclosures throughout the annual report. There are 3 areas to make sure you've covered. Operational capacity, that's things like can you continue your business, how's your workforce, what's happening with the supply chain, market demand and its effects on revenue, and financing issues in terms of availability of loans, capital maintenance. Note that even companies who currently are at their balance sheet date have a lot of cash may still come across problems. All of the disclosures about going concern should be consistent throughout the annual report, so in the notes to the financial statements, the strategic report, and your risks disclosures. So those are the key messages we had about the financial reporting effects of the coronavirus. It's important for everyone to refer to the original source information. So we've got a number of websites on the screen there which have relevant and really useful information. Now, we've talked about financial reporting today, but there have been many other regulatory changes too. For example, various tax and business support related reliefs and measures. Also changes to the insolvency laws in relation to wrongful trading, and even updated guidance on holding AGMs in this situation. So BDO's website has a COVID-19 hub with lots of guidance on a range of topics. Some of you may have listened to a webinar earlier this week on the 31st of March called Managing Cash Flow. If not, if you didn't listen, a recording is available through our website, and that explains a lot of these broader support measures in place for businesses and individuals. Okay, with that, I'll pass you over to Grant for our IFRS update.
Thanks very much, Elisa, and good afternoon, everybody. So moving on to some IFRS updates. Here we will look at an amendment to IS1, proposals to replace IS1 with an entirely new IFRS, and some IFRS Interpretations Committee comments on IFRS 16, the new leases standard, which many of you will have recently implemented. Okay, so we'll now take a look at a change to IS1. So the ISB recently announced a narrow scope amendment in relation to the classification of liabilities as either current or non-current. This should be disclosed as part of standards issued but not yet effective if it is expected to have a material effect on adoption. It has not yet been endorsed by the EU. These amendments are supposed to be clarifications of the existing requirements of IS1 and are not intended to change the basic principles. However, depending on how IS1 had been interpreted previously, this could result in the reclassification of liabilities between current and non-current for some companies. This could affect debt covenants compliance, so it will be important to consider these amendments at an early stage to assess if you are likely to have a reclassification of liabilities. The amendments are effective for accounting periods beginning on or after 1st of January 2022, but retrospective restatement of comparatives will be required. This applies to all types of liabilities, so not just, for example, bank loans. The main change to IS1 is shown on the slide. So paragraph 69 of the standard sets out 4 criteria which result in a company classifying liabilities as current. The first 3 criteria have not changed. Just these are basically that the company expects to settle the liability in its normal operating cycle, or it holds the liability primarily for trading, or the liability is due to be settled within 12 months after the reporting date. So those haven't changed. The final criteria, however, under the current version of IS1 is where an entity does not have an unconditional right to defer settlement of a liability for at least 12 months after the reporting date, then the liability will be classified as current. The amendments have removed the word unconditional and included a specific requirement that the right must exist at the reporting date. So what effect will this change have? So what exactly does having the right at the end of the reporting period to defer settlement for at least 12 months mean? So many liabilities will have conditions attached to them that could affect whether an entity has the right to defer settlement of the liability for at least 12 months. These may include covenants included in the contractual terms of a financial liability, such as a bank loan. A new paragraph has been added to IS1, which clarifies that if the right to defer settlement is subject to the entity complying with specific conditions, such as covenants, the right exists at the end of the reporting period only if the entity complies with those conditions at the end of the reporting period, regardless of when the entity is required to test that compliance. So, for example, if a bank loan has covenants such as ratios that must be met at the reporting date, and the bank can demand immediate repayment if they are not met, then the loan is classified as non-current only if the covenants are met at the reporting date, even if the bank will only review compliance based on reporting of those ratios after the reporting date, say based on their audited accounts. Secondly, what would happen if there is a right to defer settlement at the end of the reporting period for at least 12 months, but management intends to repay the liability within the next financial year? In this situation, the liability would be classified as non-current due to the existence of the right to defer settlement. Management intentions or expectations do not matter. Similarly, if a right to defer settlement exists at the reporting date, but the liability is actually settled between the end of the reporting period and the date the financial statements are authorized, this also does not affect the classification, but disclosure would be required under IAS 10 as a post-balance sheet event. The amendments to IAS 1 also clarify what is meant by settlement. Settlement means a transfer to a counterparty that results in the extinguishment of the liability. Such a transfer could be of cash or other economic resources. The transfer could also be of the entity's own equity instruments, so for example, a convertible loan. A new paragraph within IAS 1 clarifies that terms of a liability that could, at the option of the counterparty, result in a settlement by the transfer of the entity's own equity instruments do not affect the classification of the liability as current or non-current if the conversion option is classified as an equity instrument separately from the liability when applying IAS 32. In this instance, the liability would be classified as current or non-current depending on the repayment terms of the liability without considering the possibility of earlier settlement by conversion to equity. Alternatively, where the conversion option to equity is classified as a liability in accordance with IAS 32, the transfer of equity instruments would constitute the settlement of the liability and would affect the classification of the whole instrument as a current or non-current liability. In that case, where the holder can elect to convert the debt at any point in time, all components of the convertible debt will be classified as current. We will demonstrate this with an example on the next slide, but for further guidance, BDO has issued a short online training course on this amendment, as well as an international financial reporting bulletin, both of which can be found online. Okay, so in this example on your screen, we have a £100,000 convertible loan note. The loan note is repayable in 5 years' time with interest accrued at 5% per annum. However, the loan note can be converted into equity shares at the option of the holder for the cash repayment in 5 years' time. So we've got two kind of sub-scenarios set out on the slide. In the first example, or sub-scenario, the note can be converted into 100 shares at any time. So in accordance with IAS 32, this is a compound financial instrument containing a financial liability and an equity conversion feature as the option meets the fixed for fixed criteria. The conversion feature, which may be exercised by the holder at any time, does not affect the loan note's classification as current or non-current because the conversion feature is classified as an equity instrument. The principal is not due for 5 years, therefore the entity has the right to defer settlement for at least 12 months, and the principal liability is therefore a non-current liability. Accrued but unpaid interest is not convertible into shares, therefore its classification is unaffected by the conversion feature, so interest is payable annually in arrears, and therefore, as the entity does not have the right to defer settlement for at least 12 months, this will be a current liability. In the second sub-scenario, the same terms apply, except that the notes are denominated in a foreign currency as the entity has a US dollar functional currency. So as this fails the fixed for fixed criteria within IAS 32, this is a hybrid financial instrument containing a financial liability for the principal and a derivative financial liability for the conversion feature. In this instance, the conversion feature, which again may be exercised by the holder at any time, does affect the note's classification as current or non-current because the conversion feature is not classified as an equity instrument. As the option may be exercised at any time, the entity does not have the right to defer settlement of the liability for at least 12 months, and so all elements of the instrument are classified as current liabilities. So although these are narrow scope amendments, which are only supposed to be clarifications to existing requirements, the classification of some liabilities may change. Therefore, we suggest performing an assessment of existing liabilities soon to ensure that impact is understood at an early stage and leaving time to renegotiate current terms if required. Okay, so sticking with IS1, but moving on to another change. So the ISB has issued an exposure draft for a new IFRS standard to replace IS1 in its entirety, which is setting out general presentation and disclosure requirements in financial statements. The new standard would apply to all companies reporting under IFRS and would result in changes to the way statements of profit or loss and related disclosure notes are presented. The main objective of the proposals is to improve the reporting of information about financial performance in order to address investor concerns about the comparability of information in the statement of profit or loss, and to introduce a more disciplined and transparent approach to the reporting of management-defined performance or non-GAAP measures. Comments on the proposals are due by 30th of June 2020. The effective date of the proposals is not yet known, but it is expected to be 18 to 24 months after the final standard is released. While this is some way off, it is important to be aware of the proposals as they may have a fundamental effect for some companies on how the performance is reported. For example, in the UK, many large listed companies present columns for adjusted items and adjusted profit measures, and this is specifically proposed to be prohibited. Okay, so what are the headline proposals? The first one, is in order to improve comparability, the exposure draft defines 3 new profit subtotals, which entities would be required to present in the statement of profit or loss, including operating profits. Entities would also classify income and expenses into 4 defined categories in profit or loss, which are operating, integral, associates and joint ventures, investing and financing. The operating category would relate to the company's main business activities and is the default category. So these requirements would be applied differently by financial services entities. In order to improve the disaggregated information in the financial statements, entities would be required to present an analysis of operating expenses by nature or by function in the statement of profit or loss and not in the notes, and disclose an analysis of total operating expenses in a single note to the financial statements. Entities would also be required to identify and explain in the notes any unusual income or expenses. These would not be presented in a separate category in the statement of profit or loss. This is to address inconsistency around non-recurring and exceptional items under current practices. In order to improve the transparency and discipline around non-GAAP measures, and also to make these disclosures easier to find in annual reports, the exposure draft introduces a proposed definition of management performance measures, or MPMs. These are defined as certain subtotals of income and expenses, and not all non-GAAP measures would meet this definition. Entities would be required to disclose MPMs in a single note to the financial statements. Specifically, the ISB proposes to prohibit the use of columns to present MPMs in the statement of profit or loss. Proposed disclosure requirements about MPMs include a reconciliation to measure specified by IFRS standards, explanations of why the MPMs provide useful information, and how they are calculated. Okay, and finally, we have some IFRS 16 updates in this IFRS segment. So at the end of last year, the IFRS Interpretations Committee, or IFRIC, issued its final agenda decision on the assessment of the lease term under IFRS 16 leases. This decision could have widespread material implications for some lessees. BDO Global has issued an international financial reporting bulletin on the topic, which explains the agenda decision and its implications in detail with examples, so do have a look at that. So the original question asked was how the lease term should be determined for cancelable or renewable property leases, sometimes called rolling leases, where the original fixed lease term has come to an end and the lease continues on a month-by-month basis, and either lessee or lessor can terminate with 1 month's notice. Can the lease term be assessed as just 1 month, or should it be a longer period? What if the lessee expects to continue with the lease and has substantial leasehold improvements with a long useful life? So the IFRS Interpretations Committee noted that IFRS 16 requires lessees to consider three distinct time periods when determining the lease term. So the first one is the non-cancelable period, which is the period when neither party can terminate the lease, and usually this is specified in the lease. This is what is referred to as the minimum period. The next one is the enforceable period, which ends when either party can terminate the lease with no more than an insignificant penalty, and this is referred to as the maximum period. And lastly, the lease term is a period between the non-cancelable and the enforceable period and includes any option periods the lessee is reasonably certain to use. So the agenda decision concluded that lessees must consider the broader economics of leases in determining the lease term and the enforceable period of a lease. So when considering the enforceable period and whether both parties can walk away from the lease for no more than an insignificant penalty, both contractual and economic penalties need to be taken into account. This includes, for example, the cost of abandoning or dismantling leasehold improvements. So, for example, if a lessee has leasehold improvements with a useful life of, say, 12 years, the enforceable period and the lease term could be up to 12 years. The lessee would be required to consider at what point the abandonment of the leasehold improvements would constitute no more than an insignificant penalty. This may be a period less than 12 years, since the lessee may consider abandoning leasehold improvements with a useful life of, say, 1 to 2 years to be no more than an insignificant penalty. The determination of the lease term can be highly judgmental, and this decision has implications for many other situations, including undocumented and intragroup leases. Okay, so that brings us to the end of our IFRS slot for this call. I'm going to hand over to Lisa now to go through some UK GAAP updates.
Thanks very much, Grant. So here we'll take a look at some amendments and how the Triennial Review amendments are working out in practice. So firstly, in December 2019, the FRC issued FRED 73, and that was on the arose from the annual review of FRS 101 Reduced Disclosure Framework. This really just involved two minor amendments to improve the consistency of the disclosure exemptions in relation to the cash flow statement and related disclosures. The comments period for that is up, and we expect that will be finalized soon. Also in December, the FRC finalized amendments to FRS 102 for interest rate benchmark reform, or IBOR reform. Now, you might remember that similar amendments have been issued to IFRS, and this is to give some relief in respect of hedge accounting requirements, and this is because of the uncertainty that currently exists as to how long LIBOR will be available. It may not be available after 2021. And what the effect here is to avoid the discontinuation of hedge accounting. These amendments are effective from 1st of January 2020, and companies who are currently hedge accounting for, say, interest rate swaps are recommended to early adopt these amendments. Okay, so let's move on to, moving on to the Triennial Review amendments. These have been effective since 1st of January 2019, so we're in the first period of reporting under the revised standard. The Triennial Review resulted in a number of changes to FRS 102. Many changes were simply editorial or clarifications, but there were a small number of changes that could affect accounting policies or disclosures. So on this slide, we have what are probably the three headline changes. In our experience, all of these were welcomed by many preparers of accounts and have been widely used in practice. Many companies even early adopted the Triennial Review amendments in order to take advantage of these. So for small companies only, a loan from a director shareholder who is a natural person can be measured initially at the transaction price rather than at present value, as is otherwise required for financing transactions. You can't apply that change to any other type of situation. For intangible assets acquired in a business combination, the recognition hurdle has been raised, so we expect to see fewer intangible assets recognized. The criteria now are to recognize them separately when they are both separable and arise from contractual or other legal rights. Previously, the requirement was an or rather than an and. You can still choose to recognize intangibles if they are either separable or arise from contractual or other legal rights. For investment properties rented to other group companies, there is now the option to account for them using the cost model in line with property, plants and equipment rather than the fair value model. In terms of disclosures, we have a few new disclosures as well as some deleted or simplified disclosures. You'll need to prepare a net debt reconciliation. Note that there's some specific requirements for that. You can find an illustration in BDO's illustrative accounts for FRS 102. It's not exactly the same as the old UK GAAP version. If you do account for investment property rented to group companies at cost, then you need to disclose the carrying value. You'll need to describe qualitatively what intangible assets have been included in goodwill, and there's some clarifications to which types of items, costs can and should be reflected as part of operating profit. There's no longer a requirement to show the reconciliation of the number of shares. There's no requirement anymore to disclose stock recognized as an expense. If your key management personnel are the same as the directors, then you still need to disclose the director's remuneration under the Companies Act requirements, but there's no need to duplicate the disclosure. And for the disclosure of categories of financial instruments, that's been simplified, so the amortized cost items no longer need as much disclosure. On this slide, just to highlight, to give you a gist of the types of areas where there are changes to the wording in the standard, we won't go through them now. Financial instruments, changes to when the undue cost or effort exemption can be used, and specific issues relating to property, plants and equipment. Okay. That brings us to the end of the UK GAAP update, and I'll pass you back to Grant to talk about narrative reporting.
Thanks, Elisa. So in our narrative reporting update, we're going to be looking at the streamlined energy and carbon reporting and climate change disclosures, and then Elisa will be going through some Section 172 statements info as well. Okay, so moving on to climate change and related environmental disclosures. As March 2020 reporting season is now upon us, we thought it would be a good idea to cover some specifics relating to the new Streamlined Energy and Carbon Reporting Requirements, or SECR for short, that were introduced by the Companies, Directors Report and Limited Liability Partnerships Energy and Carbon Report Regulations 2018. Before we go into the new requirements that are applicable for periods beginning 1st of April 2019, it's worth pausing to recap on the current landscape and requirements around climate change. You'll see a lot of boxes on this slide. That is because there are already various disclosure requirements relevant to reporting about climate change, and there's also been a lot of recent discussion and publications on this topic. So far in the UK, only quoted companies have been explicitly required to report on greenhouse gas emissions in their directors' reports. However, climate change and other environmental matters are relevant to existing IFRS and narrative reporting requirements. In December, the ISB published an article about how existing IFRS requirements should be considered in this context. The impact of climate change on most, if not all, companies is expected to be significant and complex. It may affect the value of companies' assets and prospective profits directly or indirectly because of changes in how their businesses are operated. Increasingly, investors want to commit their money to companies and projects that will support the transition to a low-carbon economy. They therefore seek greater transparency about how issuers of listed securities may be affected by climate-related risks and opportunities. The result is various initiatives to promote more disclosure in this area. We mentioned to you last year the government's Green Finance Strategy and FRC Lab report about climate change reporting. The FRC is now conducting an FRC-wide project into climate change, and the FCA has recently called for further disclosures by listed companies, which we'll explain in a little while. So as mentioned, the new and enhanced streamlined energy and carbon reporting requirements were brought in by the 2018 regulations, which are shown on the slide. We're going to dive into these requirements over the next few slides, but for more detailed guidance, please refer to the environmental reporting guidelines that were published by the Department for Environment, Food and Rural Affairs, or DEFRA, to assist companies preparing for the new requirements. So moving on to scope. So how did the new regulations change the scope of energy and carbon reporting? As mentioned, quota companies have always been required to disclose information on greenhouse gases, so they continue to be in scope for periods beginning on or after 1st of April 2019. The requirements have, however, been enhanced, and we will cover more detail around this in a bit. Previously, unquoted companies were not required to report any greenhouse gas information in their directors' reports. However, from periods beginning 1st of April 2019, all large companies and LLPs incorporated in the UK, whether quoted or not, will be in scope of the new energy and carbon reporting requirements. Large LLPs will need to include the same information in a separate energy and carbon report, but for ease of reference, we're only going to be referring to companies for the purpose of this update. We should be familiar with what constitutes quoted companies and large companies under the Companies Act, so we're not going to go through this now. What is important is that there is a blanket exemption for large and quoted companies who are classed as low energy users. They will simply have to state this fact in their director's report and are not required to disclose anything further. A low energy user is defined as, so in the case of a quoted company, having consumed 40,000 kilowatt hours of energy or less during the period, and in the case of large unquoted companies, they would need to have consumed 40,000 kilowatt hours of energy or less in the UK, including offshore area, during the period. So what is important here is that for quoted companies, the energy usage is determined from a global perspective, whereas in the case of a large unquoted company, the energy usage is determined from a UK perspective. So those are the general scoping requirements for these new disclosures, but I'm sure you may be wondering how group reporting fits into this all. We'll discuss scoping of groups next. Okay, so parent companies that prepare a group directors report are required to report on not only their own carbon disclosures, but any subsidiaries who would be required to report under the legislation in their own directors report. Therefore, a group directors report will exclude small companies as they are out of scope, large unquoted subsidiaries who are low energy users, quoted subsidiaries who are low energy users, non-UK incorporated entities, and entities or arrangements where the parent does not have operational control. A large unquoted or quoted subsidiary for a financial year for which that subsidiary's parent company is preparing a group directors report, including relevant carbon disclosures, might not be obliged to include energy and carbon information in its own accounts and reports. There are various qualifying conditions for this, but they generally revolve around the inclusion of the subsidiary's information in that group report. So now that we know which companies are in scope of the requirements, let's take a brief look at what the key requirements are. Again, the requirements are slightly different for large unquoted companies versus quoted companies. Large unquoted companies are now required to include all the information shown on the slide in their directors' reports. The requirements for quoted companies are very similar, as you can see from the slide, but what is important is that there are enhanced or new disclosures required for quoted companies, including energy use and the information about energy efficiency action taken. So you can see that highlighted on the slide. Although very similar, it should also be noted that quoted companies report on global energy use and greenhouse gases, whereas unquoted large companies report on UK energy use and associated greenhouse gases. We'll now take a quick look at what is included in the term energy use. So energy use is defined as the amount of energy in kilowatt hours consumed in activities for which the company is responsible, involving the combustion of gas, consumption of fuel for the purposes of transport, and the purchase of electricity by the company for its own use, including for the purposes of transport. The sources of energy use and subsequent greenhouse gas emissions that must be reported in accordance with the Companies Act is slightly different for quoted companies versus large unquoted companies. It is therefore important that preparers consult with the experts to ensure that all required sources of energy consumption are appropriately included in these disclosures. Transport is an example of an energy usage source, which requires some degree of analysis when determining to what extent the related energy usage and greenhouse gas emissions should be included. The scope of transport activity is limited to fuel or electricity that is consumed by the company for its own use and doesn't include fuel or electricity that is consumed indirectly from transport activities that are not controlled by the company. So, for example, when an employee travels for business purposes on a commercial airline, the related fuel consumed would not be required to be included in the report. Once the energy usage in kilowatt hours has been determined, the greenhouse gas emissions related to its energy consumption also needs to be calculated in tons of carbon dioxide equivalents. Okay, so that gave you a quick canter through those requirements. We're going to go on to some FCA communications. So the most recent development in relation to climate change reporting is that in March, the FCA issued a consultation paper proposing the introduction of a new listing rule that will require all companies with a premium listing to either make climate-related disclosures consistent with the approach set out by the Task Force on Climate-Related Financial Disclosures, or the TCFD, or explain why they have not done so. This would be effective for periods beginning on or after 1st of January 2021. This follows on from earlier discussion papers raised by the FCA and the UK government Green Finance Strategy in 2019, which also referred to listed companies providing TCFD disclosures from 2022. The FCA consultation also incorporates a technical note applicable to all listed companies, setting out various existing requirements relevant to climate-related disclosures under listing rules and various regulatory other requirements. So what do the TCFD disclosures involve? So in 2017, the TCFD issued recommendations for a globally recognized climate reporting framework, which includes 4 core elements of recommended climate reporting disclosures. So these are governance, strategy, risk management, and then metrics and targets. I would suggest we refer to the FRC Financial Reporting Lab report on climate change reporting issued last year for guidance and used for examples of developing reporting practice following the TCFD recommendations. I'm going to hand over now to Elisa, because that brings us to the end of our climate change reporting, and Elisa is going to be covering some Section 172 information.
Okay, thank you, Grant. So Section 172 statements. This was a significant new strategic report disclosure requirement effective for the first time for December 2019 annual reports. So we've been reviewing a lot of Section 172 statements or drafts of them of BDO clients, and we thought we'd just share some observations so far. So firstly, there have been lots of questions about the scope of this requirement, with many companies questioning whether they actually needed to prepare one. And so it's important to look at the scoping carefully. It applies to all large companies as defined in the Companies Act. And that definition includes an eligibility concept, which means that a public limited company will need a Section 172 statement irrespective of its quantitative size. That includes both listed and unlisted PLCs. LLPs do not need to prepare a Section 172 statement. As a reminder, what is the Section 172 all about? It's a requirement to provide a statement which describes how the directors have had regard to the matters set out in Section 172. That includes a series of points A to F when performing their duties. There is no single right or wrong way of approaching how you would set out this Section 172 statement, but we've observed that there are typically 2 ways of approaching this. So some companies start by identifying their key stakeholder groups and set out some discussion in their strategic reports about how who those stakeholders are, how they've engaged with them, and then maybe make some reference to how that's been relevant in the year to some decision making. Others have started with the key decisions made by the board during the year, then identified any Section 172 matters most relevant to those decisions, and then talked about the directors' engagements on those particular matters. So we tend to find that the decision-led approach works a little bit better and tends to result in a more concise and relevant Section 172 statement. This is because if you start with writing about the, identifying and writing about the stakeholders, this can lead to potentially lengthy discussions involving not so relevant matters. And it may also not address how the directors balance the needs of different stakeholders when considering some of the important issues in the year. Another problem can be if the Section 172 statement focuses on individual stakeholders a bit too much, like just employees, customers, or suppliers, and then perhaps doesn't think about the other Section 172 considerations, such as the effect on the environment, the effect of any decision on the longer term, engaging in good business conduct, and acting fairly between shareholders. All of these are explicit duties under Section 172 and should be considered as part of the analysis. We do have a publication available on our website for you to look at for some guidance about this. Until generally accepted practice settles down in terms of Section 172 reporting, some of our tips for you at the moment would be to make sure your Section 172 statement is specific to the reporting period and tailored to the company's circumstances, that it focuses on the key board activities and decisions in the year. So perhaps if you had any key acquisitions, some major fundraising issues, things like that. And that it covers all of the Section 172 considerations in relation to those issues. Also would describe how you engaged with particular stakeholder groups in relation to those key decisions and what effect that engagement actually had on the key decisions. Some companies like to set this out in a sort of table format with some headings illustrated on the screen. There's no explicit requirement to do that, but it's something to consider. Also useful is to cross-reference between your Section 172 statement and discussions included in other parts of the annual report, for example, risks disclosures and corporate governance disclosures for perhaps more detailed analysis about stakeholders and other ESG matters. So that's all for Section 172 statements. Let's finish off with a few more news items from the FRC. So at the end of last year, the FRC released their thematic review topics and areas of focus. Now, all of this in terms of everyone's priorities have slightly changed in the last month or so with the coronavirus outbreak. However, we probably need to bear in mind these focus areas when preparing annual reports. So they'll be looking at IFRS 16, IFRS 15, the Brexit-related disclosures, and they'll particularly be looking at cash flow and liquidity disclosures. In the blue boxes on the screen are some of the points they'll be specifically looking at in terms of cash flow and liquidity, and I think these will be particularly important in the context of the going concern problems that many companies may face as a result of the coronavirus situation. As mentioned by Grant, the FRC is also now doing an FRC-wide project reviewing accounts audit files in relation to everything associated with climate change. The priority sectors for the year are also on the screen there. The FRC also released in January their review of corporate governance reporting, and that interestingly included a look at some early adopters, FTSE 100 companies who had early adopted the 2018 UK Corporate Governance Code last year. And the key messages from the FRC were that they did see some room for improvement in certain areas, particularly in some of those new 2018 code disclosure areas, things like purpose and culture, workforce engagement, succession planning, And he also made a general appointment reminding companies to focus not just on how you've complied with the detailed provisions of the code, but to write a bit more about how the code's principles have been applied in the context of your government's arrangements and what effect that has on the long-term success of the business. So focusing more on the actions and outcomes rather than policies and procedures. Workforce reporting was an area to improve on, and relevant to that, the FRC Lab report has issued an extensive report addressing what it is that investors expect companies to say about their workforce, and so that would be something to take a look at. Some of the key questions are on the screen there. Right, that brings us to our very last topic for the day, Brexit. So the UK has left the EU, as you will all be aware, on the 31st of January, and we are now in the transition or implementation period until the end of the year. So that means that at the moment there have been no changes to the reporting requirements, and this fact was confirmed by the FRC and BEIS in some joint letters they sent out to accountants and auditors. Do take a look at those letters if you've not seen them yet. They address accounting and reporting requirements for different types of companies. It didn't necessarily include anything new, so these letters reflect what had been expected to be the situation. The UK endorsement board for IFRS is also currently being set up. And do remember that there are still uncertainties out there in relation to Brexit, what will happen with trade talks at the end of the transition period. So in drafting the disclosures in your accounts, in the narrative reporting, subsequent events, do make those as entity specific as possible to explain what effect this situation and the uncertainties have on your company. So that brings us to the end of our financial reporting update today. Sorry we've taken a little longer than usual, but we do hope that it's been useful for you. Do contact your BDO contacts or us if you have any questions. Please join us again for our next webinar.